Let's turn to our next guest now, who's focused on today's rate hike, saying they'll push credit card rates north of 20%, right as savings dry up and Americans are adding on debt. How much trouble could that mean ahead? Joining us now is Greg McBride, chief financial analyst at Bankrate.com. And Greg, it's no coincidence we're now seeing the White House get involved here. But what does this boil down to in terms of the load consumers are facing?
Well, credit card balances are rising at exactly the wrong time. We're seeing credit card balances rise at a time when credit card rates are at a record high, and they're going to increase further. Credit card rates tend to move in lockstep with the Fed. So a quarter-point rate hike from the Fed today means your credit card statement's going to go up that rate will go up a quarter percentage point, probably one or two statement cycles down the road.
Sure. And if we look at, your mortgage is usually fixed, your auto payment is usually fixed. So this is the one area where rate hikes hit pretty much immediately.
It does. It hits very, very quickly. And it's this variable rate debt, credit cards, home equity lines of credit that are really, the Achilles heel right now in terms of your exposure to these rising rates. We've seen rates go up what will now be a grand total of 4.5 percentage points in less than a year, and the Fed probably isn't done yet. So, the cumulative effect is really having an impact on consumer spending and overall financial health.
And at the same time, right as people can finally get a return on their savings, by many accounts, it sounds like those savings are starting to run out. What are the options here? I mean, buy now, pay later, that's under its own scrutiny in terms of, I'm sure it's going to be a regulatory scrutiny as well. If the White House is trying to cap fees, that's fine, but people might ultimately exit that space. Where do you think a stretched consumer is likely to turn?
Well, that's a real question because, a lot of times what we've seen in the past is that credit ends up tightening the tighter the rules that are put into effect. And so it, ends up leaving particularly lower and very moderate income households in the position where, they're going to things like payday lenders or, the rise of buy now, pay later, that's certainly been popular even among high income households. But you're going to have people that are looking for alternatives if they can't get credit in the traditional way.
How else should we be watching for today's expected rate hike to ripple through? And again, the fact that we've had 4 points worth of hikes really in a very short period of time. I imagine that things like home and auto are areas where we'll continue to see people feel the hit.
Exactly. So a lot of those are fixed rate loans. But if the cumulative effect of all these rate hikes ends up bringing the economy into a downturn or into a recession and unemployment goes up, then you're going to see delinquencies and defaults really start to increase. So maybe not a direct correlation there, but there is definitely a knock-on effect.
What does this all tell you about where we are in the quote-unquote cycle?
It's, unfortunately, we had seen households build up savings and pay down credit card debt in the early stages of the pandemic, and we've seen it reverse now. The households are increasingly running down those savings balances and running those credit card debts back up again. And again, that's happening at the worst time, right? You're finally getting paid on your savings, and credit card rates are at a record high, yet savings are declining, credit card balances on the rise.
Yeah, so above 20%, we could be headed for some of these rates on average today on credit card debt. Greg, we appreciate you highlighting that for us. Thanks for your time.
Thank you, Kelly.
Greg McBride.